Welcome to the Daily Brief, where I'll go over the action in the market for Tuesday, January 17th, and then we'll see how things look for Wednesday, January 18th. I've been able to get back to the other software that I usually use to make the videos, so I hope the video quality and the audio quality are a little bit better, but nonetheless, I like to focus more on the content, even if the prettiness doesn't always show up all the time. We had kind of a slow day. Volume did pick up in Tuesday's session, and we declined a little bit, but we're coming off of an overbought situation. We bumped right up to a major trend line, and so we'll have to see, is that going to stop this upward movement, or are we going to be able to break through that? So let's go back and talk about what happened. Right at the open, we did have a bit of a lower open. There wasn't a real big gap. Prices then quickly rebounded. We saw a lot of buying coming in, and that can probably not really be a mystery. You had a 3-day weekend. The market's been doing pretty well. You probably had people that over the weekend, they decided, hey, let's dump some money into the market. It looks like it might be improving. And so you had a lot of retail orders that had stacked up, and those got executed, drove prices up quickly, led to a bit of a rebound after a lower open. We did not get up to R1 at 40.40. That's also a resistance level. Prices then started to retrace and ended up going negative. As the day went on, prices pretty much chopped sideways. We didn't get all the way down to the daily pivot. That was the next lowest level at 39.84. Prices did not get that far. We were down 0.2% on above average volume, just slightly above average. Our technicals are still positive overall. We still have some overbought conditions right now, but it's mainly that upward trend line. We're still looking positive, but a little exhausted right now, and we'll have to see, can we break through that line? And I'll show that to you. Inflation and interest rates are still the real big concern, both domestically and within the U.S., and earnings are really coming out, and that was a big driver in Tuesday's session. Here is how things opened with a little bit lower open, and then we quickly rebounded. We never got up to R1 before falling back and going negative. We never made it quite down to the daily pivot. We just chopped sideways and closed a little bit off of the low overall. So it's kind of a sleepy day when you take it together. What are some comments that we can make? The Dow spent pretty much all the session being negative, and that had to do with Goldman Sachs. Their earnings report came out. It was not well accepted, and that drove the price for Goldman Sachs down as well as the Dow. But the other indexes held up. And then I'm asking this question, will trendline resistance stop the rally? And I'll show you a chart of that. We're still above the 200-day simple moving average at 39.91. We could drop below that pretty easily, and we're still below this downward trend line that I keep referring to. The VIX to the S&P 500 correlation, it's still declining after being extreme positive. We've been watching that now for quite a while, and I'll show you a chart of that. The dollar was up slightly. Interest rates were a bit mixed. We're typically up overall, and copper has still been hanging on to its gains that it's been seeing lately. On a short-term basis, we have our stochastics, Stoch RSI, Williams percent R. They're still extreme positive and pretty much pegged to the top. I'll show you those charts. Intermediate term, we have the CCI 14 and 20 and the CMB composite index. A few things got taken off of this list based on Tuesday's video, but we're still looking a little extreme. And then on a long-term basis, some of our moving average studies are still looking a little extreme. We have the 10 to the 5, the 10 to the 2, and the 10 to the 3-month yield curves. Those are still inverted. I've taken the 30 to the 5-year off of here because that's now gone back to not being inverted, and it's been that way for a number of days. We'll have to see, is it going to come back on the list or be able to stay off of it? Sentiment's positive. It actually went up a bit in Tuesday's session. We're at 65 right now. We can go with that because it's not an extreme reading. We had the Empire State Manufacturing Index that came out. It was down, or gave a reading, I should say, of minus 32.9. They expected it to be minus 8.5. So this was a lot weaker than what they thought. The last time we had this report, it was at minus 11.2. Our trend is still positive. The green line's still on top. It's still going up, so it's getting stronger, but we're below 20. It's above the moving average, but still could be considered a trendless environment. I've switched our bias back over to mixed just because of the down day that we had, and we're bumping into this resistance that's above where we're at currently, but I've still kept our momentum as positive. Here's a chart that I found on Twitter, and we seem to be kind of breaking away from this. This is actually a different time period. This is 2005 through 2008, and that's what a lot of folks do, is they try to look at previous price action and then match up what we're doing now to what has already happened to try to get an idea of what might happen in the future. And it's very popular, and a lot of folks do this. I like it. I think it's interesting. I think it can be a useful guide, but I don't necessarily rely on this. But this relationship here looks to be breaking down. We should be falling down like the yellow line is doing, where the S&P has actually been going up. So it doesn't look like this relationship is real intact. This next chart is what I've been showing for a while now. And it's also showing that we could be starting to lose that relationship. But if we go back into the same basic price pattern, it would suggest that there is weakness ahead. Here is the VIX to the S&P correlation, where we really spiked up, and then we've been coming down ever since then. And we're trying to see, is that giving some support to the S&P 500? So far, it looks like it has been doing that, but we still have some resistance that we need to break through. The Ulster Index is also getting a little bit complacent now. When we're below this red line, which is the moving average, that just means there's not a lot of fear. When we go above the red line, that means there is fear. And it's just showing, kind of like the VIX is right now, which I have to show you that as well, that the market's getting a little complacent. The equity put call ratio declined a little bit on a down day, but it had been really spiking up recently, and that's what really got our attention. Here's the 5-day simple moving average, where it's pretty much sideways right now, but after giving us this really extreme reading, has really been falling. And other times when we had a really high reading, that often marked a low in the S&P. And here's a longer term look at that same chart. You can kind of make some comparisons between what happened below and then what the S&P did. Here's the VIX, where we've fallen below the 20 level, and we're getting to a pretty low level as far as there's not a lot of fear according to the VIX. Here's the line chart. Even though with the down day, we did go up slightly, and the bar chart is also, it's trying to get back up above 20, but then closed below 20. And here's the VIX of the VIX, which measures the volatility of the volatility index. It's actually been picking up a little bit. It's been going up as the VIX has been going down. And here's our trend showing how we're above the moving average, but we're still below 20. The green line's on top. So the trend is getting a little bit stronger. If you're more aggressive, you like this, and maybe you think that we're already in a positive trend. If you're a little more conservative, you want to see this continue to go up and probably get back above 20. Here's the moving average study, more shorter term, where we're not giving an extreme reading right now. We were extreme with the 20 and 50. Well, we're just a little bit extreme with the 50, but we turned down with the 20 and we turned down slightly with the 200. This is still positive overall, but we did see a bit of a decline in Tuesday's session. Stochastics still giving us an extreme positive reading in the short term, as well as the intermediate short term, and still showing improvement in the long short term. Stochastic RSI extreme positive. Williams percent R extreme positive. The CCI 14 period coming down, but still in extreme positive territory. And the CCI 20 is still extreme positive. So these are some overbought signals. And as we have these coming up, it's pointing to why we're seeing some exhaustion in the market right now. Here's the BPI. It's holding up for right now. It's above 50 and advancing, and had a little bit of an uptick. When we got that open upthrust right after the market opened on Tuesday, that helped this indicator improve slightly. Now, this is what I'm talking about. This is a downward trend line that we've played with numerous times in 2022. Now we're starting to challenge this again in 2023. We went right up to that trend line, and are we going to be able to break through that? Or like other times, is that going to mark some kind of a top while the S&P turns and starts to go back down. We're still above the 200-day moving average, so that's positive. But we want to see, can we get above this trend line? Can we close above it? And then on a weekly basis, can we print a weekly bar that's also above this trend line? We're still trying to figure that out currently. Some short-term fib levels. This shows that we have more resistance above where we're at the 4,006 level, roughly. We came right up to that level and then started to turn back down. The Swindling Trading Oscillator with the down day turned down slightly based on price and volume. Our moving average tree showing that we're above the 200-day moving averages, both the exponential and the simple moving average. But can we hang on to the gains that we've already had? Here's the CMB Composite Index showing that we're pretty extreme positive right now. And other times when we had an extreme reading like this, that often marked either a slowdown in price action, if not an actual change in the direction. McClellan Oscillator no longer giving us an extreme positive reading. It's still positive even though it declined. It's above zero. Now it's not extreme any longer. And the %B indicator, which goes with the Bollinger Bands, after giving us an extreme positive reading, has now fallen back. New highs, new lows continue to improve with that little up thrust that we saw in Tuesday's session that added some new highs. So our 5 period is advancing and our 10 period is still going up. The advanced decline line, after seeing this positive divergence based on price, it declined a little bit with the down day, but we're still above the moving average and we're showing improvement, and we were pretty much flat based on volume. Here's the longer term fib retracement level at about the 40-20 level right now. So can we get above that and then stay above that level? Here's the longer term moving average study. We're flat with the 50, but we're still extreme positive with the 150 and turned down slightly with the 200. Here's another rate of change chart that I haven't shown in a while, where we go back 250 periods. So this is quite long, where in this shorter term looking chart, it looks like we're coming down to about where the COVID low was and starting to show a recovery. When we look at this in a little longer context, yeah, we're coming down to the COVID low, but we went a lot lower than that back in 2008 into 2009 when we had the financial meltdown. So shorter term, this looks like we could be bouncing off of support, but longer term, this could be support, but we still might have some further room to the downside. The Special K is trying to turn back up. This is a very slow, long-term measurement of trend, and it's below a declining moving average, but it is trying to show some improvement. And then the home builders, where here's the S&P, and I'm going way over to the right-hand side. What we're looking for are divergences and convergences, whether positive or negative. Well, the S&P has been going up. That's been positive. The home builders, they declined a little bit in Tuesday's session, but overall they've been going up. When we take the ratio between the two, it declined a little bit in Tuesday's session, and the correlation below shows that they're having a tendency to go in the same direction currently. We're having a Copic curve buy signal that was generated right after the beginning of the year, so that's positive. And the Pring Bottom Fisher also giving us a recent buy signal. We're a little bit above the midpoint of the trend channel when we look at the long-term trend going back to 2009. One warning sign is the Dow, which had been pretty strong and pretty positive with the green bars, it switched back to neutral after the down day on Tuesday. Copper is still climbing and it's spiking up, but it hasn't really lost any of this spike. It was up a little bit more in Tuesday's session. So that could bode well better for the economy. When the copper is going up, that generally means the economy looks better into the future. When it's going down, the economy looks weaker. That kind of goes against a lot of the other things that we're seeing that are projecting economic weakness going forward. So we're not quite sure why this is happening right now. We just want to keep an eye on this. Gold is just giving us a recent golden cross, so it's now in an uptrend. And then our possible positive scenarios, they took a little bit of a hit in Tuesday's session. Here is the 19-day exponential moving average of the advanced decline line, We never really became extreme based on price, but we did get extreme based on volume, and we're starting to come down slightly. We'll have to see if that leads to further weakness. Then we take the Amex, the NASDAQ, and the NYSE. We're above the zero line. We're at least positive when we take a 5-period moving average of the highs minus the lows. And our sector rotation, we're still seeing improvement with the Qs over the S&P 500. We're still seeing some improvement with discretionary to the S&P and some improvement with large cap growth versus large cap value. And here, looking at growth versus value, we have the large caps showing some improvement. The mid caps are turning up slightly. Small caps are flat, but just barely above the moving average. And then our 2-year yield against the S&P 500 has this spiked and then is starting to come back down. That's what we're wondering currently. A lot of times when the 2-year yield starts to decline, that can provide short to intermediate term support to the S&P. Small cap index giving us a recent golden cross, so that's positive. And the small cap ratio to the S&P 500 shows that small caps are continuing to outperform the S&P 500. That could be positive for the market, mainly for this chart. The ratio is the red chart here, and when that's going up, a lot of times that will provide support to the S&P 500, which is the blue line. And then our staples to the S&P 500 ratio, it ticked up a little bit, but it's still declining after possibly giving us a spike. When it does spike and start to go down, oftentimes this marks a low in the S&P, but we've had other spikes that have faked us out in 2022, so we're having to see, will this be a legitimate spike? One headline that I came across, and I just took a screenshot, is I've been talking a little bit from time to time about what's going on in Japan and what they're trying to do, and they're kind of in their own little story right now. This was a headline that I got in Monday's session. It just says the Bank of Japan's yield curve control in danger as policy backfires. So the takeaway that I'm getting from this is what they're trying in Japan does not seem to be working. And so that could bleed through into their bond market. They own a lot of U.S. bonds. That could eventually bleed over into the U.S. bond market, which also might have an impact on the stock market. So I'm just keeping an eye on this for right now. So what's our outlook for Wednesday? The technicals are turning positive, but we need to see more follow-through buying. We have significant overhead resistance where we're at right now. If we do go back up, we'll probably become even more short-term overbought and potentially intermediate-term overbought. We have just a slew of economic reports that are coming out. This list is longer than any that I can remember in recent memory. We have the weekly MBA mortgage applications index, PPI, that'll be the big one. Retail sales, also a big one. Industrial production and capacity utilization, the Fed often uses that to make decisions. Business inventories, the NAHB housing market index. So just a lot of information hitting the market in Wednesday's session. Of course, we have all the geopolitical events. I alluded a little bit to Japan right here. We're just keeping an eye on that. But as far as the U.S. market is concerned, it's mainly inflation and interest rates, which are the real focus right now, and then earnings as they're released by each company. Looking at the Stock Trader Almanac statistics from January 2001 to December 2021, on January 18th, the Dow has been up 57.1% of the time, so that's neutral to slightly positive. Usually 60% and above is considered positive. However, the S&P's been up 71.4% of the time. Now, before we get too excited about this, remember, that means that 29% of the time it has been down. So these are just probability. These are just statistics. It doesn't mean we'll have an up day, but in large part, the January 18th has been positive for the S&P, and we have the same reading for the NASDAQ, up 71.4% of the time. These are other areas that I've been talking about already. If you look at the last 23 years, the months of January, you take them together, they've been up 43.48% of the time. They've declined 56.52% of the time. For the quarter, we're still in that 3-month window now, November, December, and January, where we tend to see pretty good returns. And then yearly, we're waiting until the end of January to get the reading for the January barometer. The market has followed that, whether it's been up or down, 83.33% of the time, going back to 1950. So far, we have a 2-0 reading for the positive. We're waiting to see for the third one. And then the market continues to like that we have a split government between Republican and Democrat. So what are our scenarios? We can't really go with the down scenario now because the technicals are looking a lot better. We're seeing some strength right now, unless you're really into that trend line that's coming down and you think that we might fall from that and really start something rather significant. It's really hard to go with the up scenario right now just because we're overextended to the upside, we're at resistance, and we're not trending. So we're still going with the sideways pattern because the ADX, although it's strengthening, is still below 20, and we default to positive because the green line is on top. So our conclusion, the S&P, it's still trying to turn more positive. We haven't really taken that out yet. On a short-term basis, we're turning more positive, but looking at some overbought conditions. Intermediate term, the same thing, turning positive, but could be coming overbought. Long-term, we're still just barely above the 200-day, so things may be improving a little bit with our longer-term charts. Thank you. Have a wonderful day on Wednesday. I hope this video was valuable to you, and I will talk to you in the next video.